we have taken measures towards rebalancing liquidity conditions while ensuring that our actions are nimble and proactive but well-timed. Now, 2 years later, as we were emerging out of the pandemic situation, the global economy has seen tectonic shifts beginning 24th February, with commencement of the war in Europe, followed by sanctions and escalating geopolitical tensions. We are confronted with new but humongous challenges: shortages in key commodities, fractures in international financial architecture, and fears of deglobalization. Extreme volatility characterizes commodity and financial markets. While the pandemic quickly morphed from a health crisis to one of life and livelihood, the conflict in Europe has the potential to derail the global economy. Caught in the cross-current of multiple headwinds, our approach needs to be cautious but proactive in mitigating the adverse impact on India's growth, inflation, and financial conditions. We are, however, reassured by the strong buffers that we have built over the past few years, including large foreign exchange reserves, significant improvement in external indicators, and substantial strengthening of the financial sector, all of which would help us to weather this storm. Please note that I'm emphasizing on 3 different aspects which places us in a position that would enable us to deal with the emerging crisis and the challenges. The first, significant improvement in the external sector. The second, foreign exchange reserves, which are at very comfortable levels. And third, substantial strengthening of the financial sector. So concerns over protracted supply disruptions have rattled commodity and financial markets. Given the significant share of the 2 economies engaged in war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. I repeated this sentence so that there is clarity in, clarity in our communication. Global crude oil prices briefly crossed $130 per barrel, touching their highest level since 2008, and remain volatile at elevated levels despite some recent correction. Global food prices, along with metal and other commodity prices, have also hardened significantly. Risk aversion towards assets of emerging market economies has increased, leading to large capital outflows and depreciating bias in their currencies, that is, currencies of the emerging market economies. These developments have, first, ratcheted up the projections of global inflation, which was already running well above the target in the major countries, and second, will produce sizable adverse impact on output across geographies. The geopolitical tensions have exacerbated at a time when the global economy was grappling with a sharp rise in inflation and consequent monetary policy normalization in major advanced economies. Global supply chain disruptions and input cost pressures are now expected to linger even longer. The resurgence of COVID-19 infections in some major economies in March and the associated lockdowns run the risk of further aggravating the global supply bottlenecks and input cost pressures. World trade and output, and hence external demand, are likely to be weaker than envisaged 2 months back. Overall, the external developments during the past 2 months have led to materialization of downside risks to domestic growth and upside risks to inflation.
If you like the video, do like, comment, share and subscribe.